Namaste, good morning. Welcome to this session where we are going to understand profits and gains of business or profession. Amongst the income topic, 5 heads of income, the most questioned or that area which is very important for our final level syllabus is profits and gains of business or profession. So by understanding this at the early stages, we will get more confidence as we progress to the other chapters. So we start with PGBP, profits and gains of business or profession, as a standalone area first, and that will never end. It will keep going on from assessment of firm, company, trust. Everything will be going on from there to with regard to PGBP. Well, before entering the chapter, let me give you a broader guideline about the chapter. Okay. The chapter has a coverage area of 16 sections. Section 28 to 44, 16 sections, but lot of subsections, lot of other parts are also there. Some sections are not even in practice, like 34 is not there, 39 is not there, 42 is a rarity. So like that, if you eliminate and see, two sections speak about income. Two sections in this entire gambit of PGBP chapter, two sections speaks about income. Okay, if I split it and see, 28 and 41 speaks about income. These are all the two sections which speaks about what is income or what type of income is taxable under this chapter. 41 is speaking about deemed income only. Deemed, supposed to be business income. The rest of the arena is about expenses. 30, 31 and 32 speaks about asset-based expenditures. In the 30, 31 are not even looked into. 32, the long travel depreciation is definitely important, but 30, 31 are sections which should have mingled with 37. I mean it. 33, deposit based deduction. In this, only one section is important, 33 AB. ABA is not a questionable area. AB for the plantation sector, that is important. 35 is a long travel section. Scientific research now becomes simpler. Specified business, something to understand over there. Amortization and social welfare elections. These are spoken in section 35. Seemingly lot, but actually boils down to lesser things. 36, other deductions. 37 general deductions. As I told you, 30 and 31 should be coupled with 37. Very small, that has no impact. So if you look at 32, 33, 35, 36, 37, that's all. The disallowance provision says, notwithstanding anything contained under 30 to 37. So in 30 to 37 it is mentioned, but there it is allowed. If they have not fulfilled, it is disallowed. So disallowance provision is not talking about a new expenditure. Disallowance provisions are not talking about any new expenditure as such. That is also speaking about these expenditure, but it will be disallowed. That's what they say. If I look at disallowance of expenditure provisions, 40 consists of TDS default as the major thing and income tax related things. That is income tax, provision for income tax, advance tax, tax on perquisites of him. But TDS default is the major thing. 40A consists of relative, which is major, cash unapproved payment by unapproved modes. These two are major. The other two things are provisions and contribution to unrecognized funds. 40A2, 40A3, 40A7, 40A9. I have already told you deemed income. 43 is a support mechanism. Support mechanism section. 11 o'clock. Support mechanism, that is, it supports all other sections. What is asset? Definition of plant, you should see 43. How to treat foreign exchange, you should see 43. How to record an immovable property sale, you should see 43. It's a support mechanism. It just gives. 44 is administrative and presumptive. Administrative, books maintenance and audit. Presumptive for residents and non-residents. This is the coverage of that 16 sections. This is the coverage of the 16 sections. Generally, on a broader scale, this is how the law approaches the 16 sections. I can boil it down to 10 sections only, which is of importance. So it's actually a straightforward, simple arena to understand. It is our fear about the chapter that makes us to complicate the whole work. I'm honest. It is a fear that this chapter is tough. Makes us to. It is not. It's a very simple, straightforward chapter. It is a very simple, straightforward chapter. One of our friends says that the video is blurred and the text is not visible properly. Is it so for all of us?
Yes, sir. Yes.
Yes, sir.
Yes, sir.
So the chapter travel is this. That is, focusing on these areas, along with, of course, the case laws relevant to that particular aspects, will make us to easily complete the chapter. Actually, it's a myth that the chapter is lengthy, the chapter is very difficult. It's a myth. Furthermore, is our examination process. I can work out 20 papers also and show you the repeated questions will be only from few arenas. The repeated questions only, thank you. The repeated questions will be only from few arenas. Not as you think everything. So, there cannot be a fear overriding our confidence in this chapter. Before going into the chapter, I want to take up one more thing so that everywhere it is said we are now clear. Before even entering direct taxation as a whole, what is unapproved methods of payment? Everywhere we are going to see if payment is made in excess of rupees 10,000 on a single day to a particular person, otherwise than by account payee check, account payee draft, banking, electronic channels, various approved. So let us go by the reverse. What are all considered as unapproved? Cash, barrel check, cross check. Cash, barrel check, cross check. These are considered as unapproved methods. All others are approved. Approved list is very big if you want. Account payee check, account payee draft, electronic transfer, NEFT, RTGS, debit card, credit card, RuPay, okay, BEAM, QR codes. All these are approved. Instead of remembering that, if you remember the unapproved, it will be simple. Cash, barrel check, cross the check are not acceptable. Starting from section 32, which defines what is the cost of the asset, till section 80G, 80GGA, GGB, 269SS, 269T, they are all going to speak about this unapproved modes of payment or approved modes of payment. So remember, if the question is going to give us cash, barrel check, cross the check, we have to recollect that these are not an approved mode of payment. Okay. So if we walk in now, how we are going to go about this in the same manner I have written. We are first going to see what is income, what is meant by deemed income, and the case laws pertaining to income. Once we are through, we will go to asset-based deduction. If we are good at income, then we are crossing a part of the chapter. Let me slowly start. Section 28 gives us the list of income which are taxable under this chapter. Section 28 is not just overall telling business income is taxable here, because in all other chapter, house property, annual value of a property, and for annual value you need to come to some other place. Capital gain, gain arising from transfer of capital asset affected during the previous year. Salary is taxable either on due basis or on receipt basis, whichever is earlier. So for all other things, here the biggest advantage is section 28 is an inbuilt section which also gives you the nature of incomes which are taxable. Section 28 is an inbuilt section which has a list of incomes which are taxable under this chapter. Profit or gain arising from business, profession, vocation. Profession is services, exhibition of skill. Vocation is specialized learning. Businesses, buying, selling, manufacturing, allied activities. Okay? So the coverage starts with the, if you go out of your house, if there is a street vendor in a cart, he is also covered in this chapter. TCS and Reliance are also covered in this chapter. If you go out and see a road show, where somebody performs an activity of skill, he is also covered under this chapter. To the all-time great Talaivar, who is also covered under this chapter. If you see an electrician, plumber, they are also covered under this chapter. To a software engineer, software architect, data software architect, they are also covered in this chapter. The coverage of this chapter is wide, huge. Whether you carry on business, profession, or vocation, please come to this chapter. Your profits are taxable here. Of course, the law says during the previous year, but there are some exceptions to this. We'll come to that in 41, though I have listed. We'll come to that. All types of compensations are taxable in this chapter. Repeat along with me. All types of compensations are taxable. Compensation for termination, modification of agency, for breach of contract, for change in managerial agreements, everything is covered in this chapter only. I have to supply 1 lakh units every month to a factory. This month, due to some reason, I am unable to supply 1 lakh unit. I was falling short. So I have to compensate for the loss they have incurred, opportunity lost for them. According to the terms, there is a breach because I am unable to supply. So they are asking me to compensate. I compensated. I compensated. For me, it is an expenditure. For the factory, for the receiver, it is an income. All types of compensation are taxable here as income, including non-compete fees. Including non-compete fees, all type of compensations are taxable here except where the compensation can be directly linked to an asset. I gave you an example that I am supposed to supply 1 lakh units of a product. I am unable to meet the supply criteria. So I am paying compensation. What if it is a machinery? I should have supplied the machinery. There are some defaults for which I paid compensation. The compensation is directly linked to the asset. In Saurashtra Cement's case, it was held where a compensation is directly linked to an asset. Where a compensation is directly linked to an asset, the compensation should be adjusted with the cost of the asset. Liquidated damages, okay, liquidated damages paid shall be adjusted with the cost. Saurashtra Cements, in page number 296 for you. Liquidated damages received by the company from supplier of plant for failure to supply within specified time. Compensation da, but held by Supreme Court that when a compensation is directly linked to an asset, such compensation should be adjusted with the cost of the asset. Don't take it as income, adjusted with the cost of the asset. The compensation is directly linked to an asset, then link it to the asset. Otherwise, all other compensations. So to conclude, all compensations are income except compensation received which can be linked to an asset. In that case, reduce it from the cost of the asset. Income derived by any trade, professional or similar association. Income derived by Confederation of Indian Industries, Lorry Owners Association, any trade. Membership fees collected by ICAI. Examination fees collected by ICAI many times from the same students like me. For you all once, be sure. Okay. Any trade, professional or similar association from specific services performed to their members. That only they are not doing any. Export incentives. This is a repeated question in our exam. Assessee sold import entitlement rights license and contended that it is a capital receipt. All type of export incentive, duty drawback, sale of import entitlement limited license, cash compensatory support given by the government, DEPB, duty entitlement, passbook, everything is taxable as income. Is taxable as income. perquisite whether convertible into money or not. Perquisites are also income. If you ask me what is a perquisite, is it a concept in PGBP? Yes, my dear friends. If you ask me what I mean by perquisite, gold coin given to an agent for achieving target. It's a perquisite income for the agent. The fair market value of the gold coin should be considered as income. Free trip to Bangkok for agents for achieving performance. Perquisite. Perquisite in the hands of the agent. Sir, I'm not going for that free trip, sir. Or I have only two options, sir. Either go or leave it. I cannot encash it, sir. Still, is it going to be perquisite? Yes, because the law uses whether convertible into money or not. Whether convertible into money or not, it is regarded as a perquisite. It will be treated as income. Value of any benefit or perquisite, whether convertible into money or not, from business or profession. All types of perquisites are income. First five, can I repeat again? First one, normal, PGBP. Profit gains from carrying on business, profession, vocation. Second, all types of compensation except compensation which is related to an asset. Third, services performed by the association to its members. Fourth, all types of export incentives. Fifth, perquisites are all treated as income in the hands of the recipient. Partner's salary, remuneration, interest from the firm. Between the partner and the firm, there is no employer-employee relationship. Partner and the firm are one and the same. Where do we know? We know everywhere. Their liability is joint and several. If the partnership firm is dissolved also, the partners at the time of dissolution are liable for all creditors, are liable for all statutory payments. So anything taken from a firm by the partner will also take the same characteristic of the income. The income will retain its characteristic. So that is also considered as PGBP income. Receipt from Keyman insurance policy. Slowly these are fading away. Okay. If the company insures the key persons, the premium paid is considered as an expenses. The maturity process is considered as income. Premium paid is considered as expenses. Maturity process is considered as income. As simple. What you claimed it as an expenditure, you got it back, so it should be treated as income. Sale value of assets used for specified business, because at the time when the asset is purchased, you claimed it as expenditure. What is claimed as an expenditure will be treated as income now. For long, conversion of asset into stock in trade, section 45 of the capital gains had the provision. The reverse provision was not there. They brought it here. Conversion of stock into asset. As if on that date you sold, whatever is the fair market value will be considered as sale value. And the last part of the discussion is subsidy. And the last part of the discussion is subsidy for a depreciable asset like our compensation adjusted with cost of asset. Like our compensation, if the subsidy is for a depreciable asset, adjusted with the cost of the asset. For a non-depreciable asset, for example, land or general subsidy, okay, promoters contribution subsidy will be treated as income. Any support from a third party which is for a depreciable asset should be adjusted with the cost of the asset. If it is for a non-depreciable asset or general in nature, it shall be treated as income. It shall be treated as income. The 10 types of income which is spoken about in section 28. Leave your material, leave your notebook, everything. Just start telling along with me. If you carry on business, profession, vacation, whatever is the profit and gains, all types of compensation except compensation which are related to an asset. For membership fees for services rendered by the organization, export incentives, say all types of export incentive, perquisites, whether convertible into money or not, partner getting any remuneration or interest from the firm or whatever name called taxable under PGBP, sale of asset used for specified business, sale of asset used for specified business, asset, stock in trade converted into asset, stock in trade converted into asset, subsidy. If it is for a depreciable asset, adjust it with the cost of the asset. Everything else you can take it as income and insurance receipts. These are all the 10 types of income which are spoken about in section 28. Quick reading, please. Okay, okay. all of us listen. Of course, this comes later in the chapter, but I am trying to put it here so that once our income discussion is over, we will feel, yes, I know something. Deemed income. Expenses, losses, deductions. Expenses, losses, deductions claimed earlier, now recovered. Any expenses, losses, deductions claimed earlier, now recovered, will be treated as income. Will be treated as income. Very simple logic, sir. Previously, I claimed it as an expenditure. Now I got it back. Simple logic only. It is an income. Bad debts, I claimed it earlier as an expenditure. Now I get it back. It will be treated as income. Electricity bills I paid. Now I am getting some benefit because my factory is in a backward area. So the EB, electricity board, refunded me some part of my bill payment. Income. Any expenses, losses, deductions claimed earlier, now recovered. The law says scientific research and specified business, except land, all other assets also you can claim it as deduction. You cannot claim for land, for building, plant and machinery, equipments. All asset value itself, you can claim it as deduction. You claimed it as expenses. Sale of such assets. After the research, after the specified business, after some point of time, you are selling that asset. The law says, boss, when you purchased it, you took it as an expenditure. Expenses, losses, deductions claimed earlier. Did you claim the scientific research asset as expenditure earlier? Yes. Except land, for everything you can claim. Now you are selling and recovering something, no? Treat it as income. Any expenses, losses, deductions claimed earlier, now recovered, shall be treated as income. Bottom line is very clear. It's a simple logic which we do in our normal, any illiterate will say, if I spend something, it is an expenditure. I have spent extra, so they return me back. That is an income. A reduction in expenditure is equivalent to an income. So any expenses, losses, deductions claimed earlier, now recovered, it is an income. You purchased goods on credit. Creditors waived off the money. That also is income. Because when you purchase, what entry you passed? Purchases account debit to creditors. Where did you take the purchases? To the debit side of profit and loss account or trading profit and loss account. You claimed it as an expenditure. Claimed earlier, now recovered slash ceasing to exist. Either it can be recovered or no more payable. That will also be income. That will also be income. One minute, I will come to those things. Any allowances, losses or deduction has been claimed in the earlier years. Subsequently, the same has been recovered or ceased to exist. Then the same shall be treated as income in the previous year. Bad debts, scientific research asset, telecommunication, withdrawal from reserves. It will all be treated as income. It will be treated as income even if you don't do business in that year. Even if business is not carried on. When you carried on the business, you claimed it as a deduction. Now you have closed the business. Couple of years back, I was a practicing chart accountant. On a day, I quit practice and came. Now a client who I had served at that time comes and pays me fees. Is it taxable in this year? Yes. Is it taxable under PGBP? Yes. Even though I'm not carrying on, it is taxable. It is even taxable to the successor of business. Amalgamation, conversion. It is even taxable to the successor of the business. Successor of the business, one bottom line I'll give you. Provisions will apply to the transferee company or transferee entity as it would have applied to the transferor had the event not happened. Amalgamation, demerger, conversion of firm into company, sole proprietor into company, company into LLP. In all these cases, provisions will apply to the transferee entity as it would apply to the transferor as if the event has not happened. For the transferor, is the bad debts recovered taxable? Yes. For the transferee also taxable. For the transferor, sale of scientific research taxable? Yes. For the transferee also, the provisions will apply to the transferee as it would have applied to the transferor had the event not happened. So, deemed income. Any allowance, loss, deductions claimed earlier, now recovered, or the liability ceases to exist, it will be treated as income. In that, there is something which you have to understand, okay, which is treatment of waiver of loan. This is important to understand. This is important to understand. Waiver of loan, my dear friends, there can be three types of loan. Term loan, working capital loan, and interest that is accrued. Term loan, working capital loan, interest that is accrued. Working capital loan is a trading liability. Working capital loan is a trading liability. That is against stock, debtors, etc. Waiver will be treated as income. The waiver of working capital liability will be treated as income. Whereas term loan is for purchase of asset. So we go back to Saurashtra Cement's case. In fact, there was a case called Steel Authority of India Limited, where they said, if I have taken a loan on purchase of an asset and the banker waives that loan, the waiver should be adjusted with the WDV of the asset. Written down value, opening value of the asset. Once more, shall I repeat? If I have taken a loan for purchase of an asset, asset account debit 1 crore, to bank I paid 10 lakhs, to loan from State Bank of India 90 lakhs. I was unable to pay 15 lakhs back. Out of the 90 lakhs, I paid 75 lakhs. I was unable to pay 15 lakhs. Now the asset value is only 85 lakhs. Bank waived it. Now the asset value is not 1 crore. Because out of that 1 crore, 15 lakhs is borne by the bank. 10 lakhs I initially paid and repaid to the bank 75. 75 plus 10, 85. So adjust that 15 in the asset value which is there in the opening WD. I will talk about interest later also. Now on a smaller scale, understand, though if you can recollect this provision, even you need not have studied in final, if you study in intern, interest is a statutory payment. To claim it as deduction, it should have been paid within the due date. If you have not paid the interest within due date, the interest is disallowed. Repeat, if you have not paid the interest is disallowed, which means you have already taxed it. Expenditure claimed, any losses, expenses, deductions claimed earlier. I did not claim, boss. You did not allow me to claim. Because I have not paid in 43B, you have already disallowed. So this claimed earlier is missing. I have not claimed. At the time of waiver, it will not be treated as income. At the time of waiver, it will not be treated because already I have taxed. If I again tax, it is like dually taxed. It is like dually taxing. So at the time of waiver, it is not treated as income. It will not be treated as income. Quickly, section 41 says, any expenses, losses, deductions allowed earlier, now recovered, will be treated as income. It will be treated as income even if you have discontinued your business. Even if the business is succeeded by another person, for them also it will be treated as income. Apart from this, any trading liability which is waived means it does not exist. Trade creditors return back, short-term loans return back, current liabilities return back, shall be treated as income. In case of bank loan waiver, I need to see what type of loan. If it is term loan, then it is for the purchase of asset. It is not a trading liability. So adjust it with the cost of the asset. Cost we need not be known. Whatever is the WDV, adjust it against it. If it is a working capital loan, OCC, OD, against stock, debtors, bills, it is a trading liability. Waiver is an income. Interest, need no change because already you have taxed it. Now you need not again tax it. This is what is income put together in section 28 and 41. Quick read through, please. Sorry, I am highlighting in the wrong material. Section 28 and 41 speaks about income. Okay? Okay? There are three case laws which are of importance. Chennai Properties and Investments, Rayala Corporation, NDR Warehousing. These three discussed about when will rental income be treated as business income. In this, the NDR warehousing is slightly different. The other two, the basic Chennai Properties case, it was held. Please remember the judgment and the easy words. Where the object class of the company says that the company's main business is letting out. Where the object class of the company says that the company's main business is letting out of properties. And the substantial income is from such source. It should not be an object class mentioned alone. In Rayala Corporation they said, and the substantial income should be from that. If these conditions are satisfied, rental income from letting out of property is considered as business income. Oyo House. Many service apartments, they all derive rental income only from house property only. Is it taxable under IHP? The answer is no. It is taxable under business or profession, because the main object is letting out, and the substantial part of the income is also from such letting out. NDR warehousing. That company was constructing warehouse, letting out warehouse along with amenities to various people. Assessing officer contended it is IHP. Why people contend IHP means only two deductions, 30% standard deduction and interest on borrowed capital. PGBP means you can claim more deductions, security charges, maintenance charges, electricity, office expenses. So many things you can claim. So people can. Court said they are not only doing warehousing activity. One, their main business is warehousing. That is different. They are also doing maintenance. They are also taking care of the goods. So it goes beyond warehousing. So it should be treated as business income. A and Co. Very interesting. I need to obtain bank guarantee to give to my suppliers. Bank guarantee will be given only if I keep the margin money as deposit. I kept the margin money as deposit, got the bank guarantee, gave it to the supplier or customer, whoever it is, for delivery, etc. On the margin money, I earned interest. The court said this margin money is related to the business. So the interest is a business income. Very, very extraordinary decision. If surplus funds is invested, that interest is taxable at IFOS. Once more, if surplus funds is invested, that interest is taxed under IFOS. If only margin money, which is essential to carry on my business, is invested, that is taxable under PGBP. Asian Hotels, leave it. Okay. Can you quickly go through page number 180 for the case loss? Quickly go through. Let us answer some questions on income. Subsidy received as a general contribution is an income. It is an income. Subsidy received towards construction of hospital building should be adjusted with the cost of the building. Should be adjusted with the cost of the building. Why? Because the hospital building is an asset. Depreciable asset. Only land is the not depreciable asset, and goodwill might not be a depreciable asset. For goodwill and all, people might not give subsidy. So only land is a non-depreciable asset. Others are depreciable asset. So subsidy received towards a depreciable asset should be adjusted with the cost of the asset. So here it is not an income to be adjusted with the cost of the asset. Not an income to be adjusted with the cost of the asset. Okay, right? So it should be reduced from the cost of the asset. Okay, right? Compensation received for breach of contract, income. Income. Compensation received for failure to supply plant and machinery. Saurashtra Siemens case. Where the liquidated damages are related to an asset, identifiable with an asset. The Supreme Court held, adjust it with the cost of the asset and don't treat it as income. Non-compete fees, income. Some say for professionals it is capital gains, for others income. Now you take it as income for your year. Export incentives, sale of duty entitlement license, passbook, cash compensatory support, duty drawback, everything is an income. Duty drawback, sale of import entitlement license, cash compensatory, everything. Payment received from by a partner from a firm, taxable under PGBP. It should be allowed in the hands of the firm, that's true, but taxable under PGBP. Sale value of asset used for scientific research or specified business, income. 41, deemed income. If the sale value exceeds the original cost, that excess alone capital gains. If you want an additional answer, I haven't seen questions like that, but if the sale value exceeds the original cost, that excess alone capital gains, because whatever claimed earlier now recovered is only income. 1 lakh I purchased, 1 lakh I claimed. Now that 1 lakh recovered is income. I recovered 1,20,000. 1 lakh PGBP, 20,000 capital gains. Okay, very rare, but still. That's recovered income provided allowed earlier, because we all know any expenses, losses, deduction claimed earlier now recovered. Travel expenses incurred by the principal company for achieving target, income, whether convertible into money or not. Whether convertible into money or not, it is treated as income. Whether convertible into money or not, it is treated as income. Waiver of working capital loan interest portion. No adjustment, because it would have been already disallowed under PGBP. Now you need not make any adjustment. No adjustment. Now you need not make any adjustment, because it is already. Working capital, waiver of working capital road, principal portion, income, trading liability waiver. Trading liability waiver, it is an income. Cessation of trading liability. Any current liability if it no more exists. Any current liability if it no more exists, that is known as cessation of trading liability. It will be treated as income. Where creditors are not paid, then the same will be treated as income. This provision is also applicable for the successor of business or even if the business is discontinued. Assessee is a property company predominantly in the business of letting out of property, and the same form part of their main object of the company. Chennai investments, properties and investments, where it is said in the object clause and it is predominant revenue is from that, the income will be taxable under PGBP. Repeating, Chennai properties and investments, where it is mentioned in the object clause that letting out is a main business and substantial part of the income is from letting out, taxable under PGBP. Assessee company, a warehousing corporation, was predominantly involved in the business of letting out building and godown, but was also providing security and transport services. NDR warehousing. NDR warehousing. Business income. Business income. Not only is the services or object class, but also it is providing additional things, amenities. Liquidated damages received by a company from the supplier of plant for failure to supply within time. Saurashtra Cements. Saurashtra Cements. Treated as income. Treated as part of cost of asset. Not treated as income, to be adjusted with the cost of the asset or WDV of the asset. Interest received on excess application money deposited in a bank. PGBP, Sri Rama Multi IFO is there in the case now. It's a business income. Sorry friends, I will come back to that. I'll come back to that. You will very soon. IFOS, I have that case. I don't remember it citation straight away, but IFOS, you have that case. Okay, multi-techo, I'll come back to this case very soon. Okay, but it is a business income. That is, you have to keep the money deposited in a separate bank account. You have to keep the money deposited in a separate bank account. So the income is considered as business income. The income is considered as business income. Okay, the income is considered as business income. You don't have an option, so it will be business income. Okay, I'll check here whether I have the case law written. Sri Rama Multi-Tech Limited. Sri Rama Multi-Tech Limited. Okay, that is the case law. You will see it in IFOS. Okay, it was held that deposit of application money is a statutory requirement and it cannot be linked as surplus funds deposited. Any interest will be taxable as business income and is available for set off of expenditure. Sri Rama Multi-Tech. You have this case law. It will be coming later. Interest on margin money deposited with bank for obtaining bank guarantee K and Co. K and Co. It should be business income. K and Co. It should be business income. Nothing more than that will come in the income. Nothing more than this will come in the income. Be sure this is only income, business income. They might give in the adjustment import entitlement license, sale value of scientific asset, margin money interest. If they have already credited it, you just write a note saying that it is a business income. If they have not credited it, you write it and add it up to the profit because it should be treated as income. Section 29 of the Act says how to compute business income. Section 29 of the Act says how to compute business income. Difference between revenue, very simple. In our income tax law, Section 29, business income, which we all know, 28 and 41, minus allowable expenses. So the stress is on the word allowable. The stress is on the word allowable. Whatever is allowable expenses can be claimed. And this allowable expenses is split into P. Okay. Expressly allowed by the law. 30 to 37. 30 to 37 expressly allowed by the law. Expenses not allowed, expressly disallowed by the law. 40 and 40A. Allowed on cash basis. On the basis of payment, 43B. Repeating. Expenses expressly allowed, 30 to 37. Disallowed, 40 and 40A. Allowed only if you make the actual payment, 43B. Let us walk into the first arena. That is 30 to 37, as I told you, is divided into these many units. First, let us see asset-based, deposit-based, 35 as a standalone, and then these we will club. First, let us go asset-based. Asset-based, I said 30 and 31, either both of them should be clubbed or both of them should be put in 37. They are not at all. There is no point in having it as a separate expenditure. Right. What can be claimed against the building? You can claim rent. If it is a rented building, rent. If it is your own building, repairs. The word they use is current repairs. Don't claim capital repairs. Repairs, maintenance, taxes, insurance can be claimed. Insurance on stock, group insurance are all claimed under 36. So you can put there itself one extra line or bring it in 36. There is no point having a separate section for this. Okay, coming back. That we'll at least tell to ourselves, I know so many sections. Okay, section 30, expenses in relation to building, rent, repairs, current repairs, maintenance, municipal taxes, insurance are all allowed as deduction. Expenses for plant, machinery and furniture, hire charges, current repairs, maintenance, insurance are all allowed as deduction. We will start understanding depreciation in its full form. Reduction in the value of asset due to usage, change in technology and lapse of time. Reduction in the value of asset due to usage, change in technology and lapse of time is known as depreciation. Depreciation can be claimed if the following conditions are satisfied. Depreciation can be claimed if the following conditions are satisfied. It should be a specified asset. In income tax law, specified assets are building, plant and machinery, furniture, fixtures, intangibles. Repeat with me. Building, plant and machinery, furniture, fixtures, intangible. Land is not a specified asset, no depreciation. Sir, where is this vehicles? Where is this computer and all? In Income Tax Act, they are known as plant. In income tax law, they are known as plant. Land is not a specified asset. Plant and machinery, the terminology is process equipment which convert raw material into finished product. Ship, aircraft, vehicles. So ocean going, land going, air going, everything is plant. Computer and its accessories is plant. Electrical fittings is plant. Books is plant. Scientific apparatus is plant. Surgical equipment is plant. Everything is a plant. Air conditioner is a plant. Light is a plant. Fan is a plant. Everything in income tax law is a plant. The definition of plant is huge, which is there in section 43, subsection 5. What did I say about 43? It is a supplying section, support section. It is not by itself doing anything, but it is like a definition. So these are plant. Building, plant and machinery, furniture, fixtures, intangibles, know-how, patent, copyright, trademark, franchisee agreement, business or other commercial right. Know-how, patent, copyright, trademark, franchisee agreement, business or other commercial right. Goodwill is not mentioned, but they said business or other commercial. Smith Securities. I have removed. Smith Securities. Ravindranath, in all those, Dr. Ravindranath, in all those cases, they said business or other commercial right is also includes goodwill. In the Finance Act 2021, our finance minister, madam, specifically said goodwill will not enjoy any depreciation. This budget. And when the finance bill came, we understood it is from 1/4/2020. We understood from 1/4/2020 goodwill. So, even for previous year, financial year 2021, goodwill cannot be claimed or depreciation cannot be claimed. That's why I removed those case law. To nullify that case law, only the law was amended. So why to waste time? I removed that case law. Smith the securities, it will be there in your material. Now it is no more valid. So for goodwill, you cannot claim. Know-how, patent, copyright, trademark, you can claim. License, etc., you can claim. So, first condition is it should be a specified asset. Specified assets are this. Land is not a specified asset. Goodwill is also not going to be a specified asset. Plant and machinery includes data processing equipment and general machinery. General machinery, data processing equipment. And the plant and machinery has various rates. There were two case laws in our income tax law. Federal Bank and BSES Emuna. Repeat with me. Federal Bank, BSES Emuna, which explain this term, what is accessory. That which does a support role. You all know about accessories. Why should I tell? That which does a support role. Without the main, the accessory does not have any validity. It just supports. So it gets the rate of the main item. Printers and scanners cannot work without a computer. Printers and scanners are meaningless without a computer. So the rate applicable to computer is applicable to them. Whereas mobile phones and EPABX, mobile phones and this telephone intercom can work even without a computer. So for them, depreciation is only 15% and not 40%. Printers and scanners are an accessory, peripheral or accessory, whereas mobile phone and EPABX are standalone equipment. So in Federal Bank case they had and BSES Emuna case they held, for printers and scanners 40% depreciation, tag it along with computer, whereas EPABX and mobile phone only claim 15%. They are standalone equipments. It should be owned by the assessor. Owner can only claim depreciation. We all know. But the law uses the term not just the legal owner, beneficial owner. Not just the legal owner. Substance over form. A car which is funded by the company, is registered in the name of director and used by the company. Who is the registered owner? Director. Who is the beneficial owner? Company. Invested by the company, used by the company. Invested by the company, used by the company. They only should claim depreciation. Concept of beneficial ownership. Not just the legal ownership, but the beneficial owner should claim the depreciation. A. Sivakami and Co. The HUF is in the business of running vehicles on hire. The HUF is in the business of running vehicles on hire, like cabs. They purchase the cabs in the name of the individual. They purchase the car in the name of individual. They only funded it. They are only using it in the business of running them on hire. Who can claim depreciation? The HUF can. Why? The legal owner is that individual, but the beneficial owner, income from the car is accruing to the HUF, funded by HUF. Depreciation also can be claimed. The term ownership here means beneficial owner. But there came a case concept which went up to Supreme Court to get the clarity, which is very simple. ICDS Limited. Company is in leasing business. And in leasing business, purchased vehicles registered in the name of lessee itself, because ultimately he is going to take the vehicle on payment of final charges. Got lease rent from the lessee. Claimed depreciation. On income tax officer, the income tax officer said you are not eligible to claim. You are not the owner of the asset. You are not using the asset. Why are you claiming depreciation? Repeat. The income tax department said you are not the owner of the asset. You are also not using the asset. Why are you claiming depreciation? The assessee contended, who said I am not using the asset. I am only using the asset. By giving the asset to the lessee, I am using the asset. Using doesn't mean I should drive the lorry. My business itself is leasing. My business itself is leasing. In leasing business, by giving the vehicle to the lessee, I am using it for my business. You are not understanding my business model. Usage here doesn't mean I drive the vehicle. I give the vehicle to my lessee. By giving it to the lessee, I am using the asset. And this registration is just a formality. Why should I pay twice the registration charges? Substance over form. Supreme Court held ICDS can claim depreciation. By leasing the asset, they are owning the asset. And they are using the asset. Logically also see, the lessee will pay lease rent, which he will claim it as deduction. He will also claim depreciation. Only the lessor can claim. Ownership. Don't just look at the document. Don't just look at the document. Look into the substratum. Look into the main purpose. Look into the nature of transaction. So came this concept called beneficial ownership. So came this concept called passive usage. Income tax law always tells us ready to use is also use. A spare machinery which is kept ready, if the main machinery goes out of order, spare machinery will be used. Last year, full year, the main machinery was running well. Spare machine was not used, so I cannot claim depreciation. Or no, boss, lapse of time will also give you depreciation. The term usage doesn't mean daily you should start. Ready to use is also considered, is also applicable for depreciation. Okay, okay, okay. So, in order to claim depreciation, assessee should own the assessee. Ownership is determined only by title deeds, and it can be claimed by the beneficial owner. The one who funds it. If there are more than one owner, for their capital contribution, let each owner claim. And usage is active as well as passive. Ready to use will be eligible for depreciation under income tax law. Page number 190, the case laws which I discussed are there. Have a quick look through. Give me 5 minutes. Yes, friends. So, owner can claim only the claim depreciation and usage. Then comes a concept called block of asset method of depreciation. Under income tax law, only block of asset method of depreciation. Depreciation can be claimed only on the principle of block. Block means group. Block means group. Assets will be grouped, and on the group balance only depreciation can be claimed. Once more, assets will be grouped, and on the group balance only depreciation can be claimed. Not on individual assets. Assets of similar nature having same rate of depreciation will be grouped, and on the group depreciation. So if there are 100 computers put together, it is known as group of computers. 10 vehicles put together, they are known as group of vehicles, block of vehicles. 3 factory buildings put together, they are known as block of factory building. And on the group balance only, depreciation will be claimed. Assets of similar nature having same rate. Both these things, building and furniture, both might be 10% depreciation. Same rate, but they are not similar nature. Car and machinery might be 15%, but they are not of similar nature. It should be similar nature, same rate. Then it will be grouped together and depreciation will be claimed on group balance. Our income tax law gives us a format of depreciation, claiming depreciation. Our income tax law gives us a format for claiming depreciation. It starts with the opening balance, which is nothing but the last year's closing balance. It starts with the opening balance. Purchase of asset is split into two. On or before October 4th, after October 4th. On or before October 4th, after October 4th. Used for 180 days or more. What is usage? Ready to use is known as put to use. In the year of purchase. Again, I am repeating, only in the year of purchase, not for opening balance. Opening balance you can claim. Even if you don't use it, you can claim, because lapse of time will also give you depreciation. Even if you have not used it on the opening balance, but for asset purchased, used put to use for 180 days or more, claim 100% of eligible depreciation. If the rate is 15%, claim 15%. If the rate is 20%, claim 20%. 40%, claim 40%. Whatever rate is given here, claim fully. If it is put to use for less than 180 days, claim half of the eligible depreciation. Claim half of the eligible. If the rate is 15%, claim 7.5%. If the rate is 20%, claim 10%. If the rate is 40%, claim 20%. Indirectly, the law says, income tax law does not recognize proportionate basis of depreciation. Repeat, income tax law does not recognize proportionate basis of depreciation. What is proportionate depreciation? I purchase an asset on July 1st. Our general accounting practice and company law says asset value into rate into 9 by 12. Purchased on August 1st, 8 by 12. September 1st, 7 by 12. October 1st, 6 by 12. November 15th, 4.5 by 12. January 1st, 3 by 12. Income tax law does not recognize proportionate basis of depreciation. You purchase and start using from 30th September also, take full depreciation. You purchase and start using from 31st March also, take half of the depreciation. Whereas accounting practice says asset value into rate into 1 by 365. Income tax law says take full. There is no proportionate basis of depreciation. The split is 180 days or more, less than 180. That's all. Opening, additions divided into two, less sale value, insurance receipt, whatever it is. Excellent concept. Simple, directly reduce sale value. 40,000 worth of machinery. sold for 50,000. Accountancy says bank account debit 50,000, to machinery 40,000, to profit on sale of machinery 10,000. 40,000 worth of machinery sold for 25,000. Accountancy sale, bank account debit 25,000. Loss on sale 15,000. To machinery 40,000. Income tax says less 50,000 you put, or less for 25,000 you put. There is no concept called profit or sale of asset. Why? Because I don't know which asset is sold. Accountancy, you are depreciating individually every asset. So you know its book value, sale value. Here block of asset concept. Here block of asset concept. I don't know which asset you have sold. So whatever is your sale value, I will reduce it. And on the balance, I will claim two types of depreciation. Normal depreciation, which is available for all. Normal depreciation, which is available for all. Additional depreciation, which is available only for a manufacturing entity, for plant, machinery and computers used directly or indirectly in manufacturing. Repeating, there are two types of depreciation I will claim: normal, available for all; additional, only for manufacturing entity, for plant, machinery and furniture which is directly or indirectly used in manufacture. We will speak about it more. This is the format of our depreciation. Please look into this format once. Okay, okay, okay. Let's understand it little more. Let's understand it little more. Okay, let me complete the theory and come back so that our understanding will be better. Okay. Opening WDV, last year closing WDV. Addition, we will incur all the charges in addition. Okay, we will, whatever is incurred like our accountancy, it is part of addition. I'll come to Forex fluctuation soon. Okay. Addition I will discuss very soon. Okay. Sale consideration is whatever I receive. Okay. And bifurcate between 180 days and more, because less than 180 days, only half of the depreciation can be claimed. Normal depreciation is computed on the balance available after reducing the assets out of the block. Depreciation is at the rates. Okay. Only diminishing balance method. Exception is only electricity companies where they can follow straight line, not a questionable area, don't worry. Only diminishing balance method. I want to talk about additional depreciation. Then keep working some questions on depreciation. The normal rate of plant and machinery is 15%, 15%, which is a very small. So to boost that sector, they brought this additional depreciation. And the word additional has a very important meaning. Additional signifies two things other than normal, only for addition. The terminology additional signifies two things. Additional income tax, that is, apart from normal income tax, you will pay additional income tax. For example, buyback of shares. Till last year, we saw additional income tax where secondary adjustment is unable to be repatriated. Additional income tax, apart from the normal tax, you will also pay that. Additional depreciation in addition to your normal, one meaning. Second, only for addition, this depreciation is. Only for addition, this depreciation is. It is not for the opening balance. It is not for the sold asset. It is only for the addition. Why am I giving it? I told you. Because the normal rate is less for a manufacturing entity, and it will also be for generation and distribution of power. For what asset I can claim? For new plant and machinery, and if there are computers which are facilitating manufacturing process, claim it. But it should be new. It should not be second hand. It should be new, because one other person has already claimed, you also claim it, not possible. Rate of additional depreciation 20%. And if the asset is put to use for less than 180 days, interpretation of law 10%. Repeating, income tax law says rate of additional depreciation 20%. Income tax law also says if the asset is put to use for less than 180 days, half of the eligible depreciation can only be claimed. Very difficult. Very difficult. So came this concept in a case law and then became the law, where only half is claimed in the first year. The remaining half can be claimed in the second year. Where in the first year, assessee only claims 10%. Why he claims only 10%? Because he has put to use for less than 180 days. The balance 10% can be claimed in the immediately succeeding year. Anyhow, claim 20%, no problem. What is not new, it's whatever is already used in India or outside India, Whatever is not installed in factory, etc., are not considered as new. Can you quickly read except additions? Can you quickly read once? Quickly read. I'll come to additions as a separate area. Can you quickly read these things? I mean, question number 1 should be 191 for you. Opening WDV 70 lakhs, new plant and machinery put to use 40 lakhs on 8th June, 15th January 19 lakhs. On analysis, you find that last year, that is 1920, there was an put to use for 23 lakhs. Compute eligible depreciation, assuming it's a manufacturing concern and the asset is used for the purpose of manufacturing. The June purchased asset. Okay, if the date of put to use is separately given, take that date. Otherwise, purchase the is put to use immediately. This is the Jan purchased asset of 19 lakhs. This will be anyhow there in the opening balance itself. This information is for some other purpose which you can understand. Amount available for depreciation. That is the balance available for depreciation, which comes to 1 crore 29 lakhs less depreciation. Normal. How do I compute 19 lakhs into 7.5%? Because asset used for less than 180 days, you can claim only half of the eligible depreciation. So 19 lakhs into 7.5%. 19 lakhs which is used for less than 180 days. 1 crore 29 lakhs minus 19 lakhs, because on that 19 lakhs you have claimed only half, into 15%. You should not add up these two things and put 50. In this question, okay. But if there is a sale value, no, it will be difficult. So always 19 lakhs into 7.5. Whatever this value minus put to use for less than 180 days. So you will get 19 lakhs into 7.5% plus this minus 19 lakhs into 15%. Addition. $40 lakhs into 20% plus 19 lakhs into 10% plus this is more than 180, 20%. This is less than 180, 10% plus last year I have purchased an asset on 18th Jan 2020. So last year it was used for less than 180 days. I would have claimed a depreciation of only 20%. 10%, sorry. I would have claimed a depreciation of only 10%. The balance 10% can be claimed in the immediately succeeding year, that is this year. 23 lakhs into 10%, as last year it was put to use for less than 180 days and only half would have been claimed. So what happens? Okay, 40 lakhs into 20% plus 19 lakhs into 10% plus 23 lakhs into 10%. I get a depreciation of 1720. Closing WDV. Remember, the answer is depreciation and not WDV. The answer is this, depreciation. Okay, the answer is this one. So total depreciation for financial year 2021 is eight. is an amendment, I don't find a question. If the unit is located in Bihar, notified area. Till last year 1920, the additional depreciation for a unit located in notified areas of Bihar, West Bengal, Andhra Pradesh, Telangana. Bihar, West Bengal, Andhra Pradesh, Telangana was 35%. Was 35%. From this year, it is only 20%. Only one possibility is, last year you purchased and claimed 17.5. This year you can claim the balance 17.5. I don't think question will come. I sincerely don't think question will come. But anyhow, to be on the safer side, somewhere store it in your mind. Okay, so nothing changes except this will be 17.5%. Okay, as last year this were only half would have been claimed. Okay, so last year it was 35%. So this answer alone will be 17.5. Otherwise the same working. Very rare, I don't expect a question. Okay, then for the 70 marks there is so much to question, so amendment provision they will never question. Question number 3. I'll come to question number 2 later. Additions, I will deal with it quickly but neatly. Question number 3. XYZ Limited, a manufacturing concern, furnishes the following. Opening WDV of plant and machinery 30 lakhs. Asset purchased on 8th June 20 lakhs only, my dear friends. 20 lakhs, not 2 crores, 20 lakhs. 15th December, 8 lakhs. In the next year, opening WDV 3 lakh. Opening by WDV, we need to find out. Asset purchased for more than 180 days, 3 lakhs, 15 lakhs. Less than 180 days, 11 lakh 50. And what is the amount of depreciation and additional depreciation for financial year 1920 and 2021, or assessment year 2021 and 21-22? Sorry, financial year 2021 and 21-22, that is assessment year 21-22 and 22-23. Please work along with me. You all know that normal 8 lakhs into 7.5% plus 58 lakhs minus 8 lakhs into 15%. For next year, I will not work out like this. I will directly go to the answer. Additional 20 lakhs into 20% plus 8 lakhs into 10%. Repeating the normal depreciation, 8 lakhs into 7.5% plus 58 lakhs minus 8 lakhs into 15%. Additional 20 lakhs into 20% plus 8 lakhs into 10%. Closing WDV, which will become the opening WDV of the subsequent year. Total depreciation $18 lakhs and 11,50,000. 3 lakh plus 15 lakhs. Both are 1. And here it is 11,50,000. In the additional depreciation alone, I will have the last year I claimed only 10%. I can claim the balance 10%. I can claim the balance 10%. Check whether you are getting the same answers, please. Okay. This is the depreciation 1290 and 1587 750. Lights and powers. Engaged in the business of generation and distribution of power furnishes the following. Compute the allowable depreciation while computing PGBP. Opening WDV 578. purchase the second-hand machinery, you cannot claim additional depreciation. You cannot claim additional depreciation for this, but normal depreciation can be claimed, and it is purchased and put to use for less than 180 days. Machinery Y purchased and installed in the first of 8 lakhs for generation of power. Acquired and installed a new pollution control equipment 40%. Okay, that is a different asset. New machinery purchased and put to use for less than 180 days 325. Sale value of old machinery 310. Read through. Okay. Opening WDV 5,78,000. Here it is nil. Additions. Okay. More than 180 days, this 8 lakhs. More than 180 days, this 8 lakhs. Put to use for 180 days or more, 8 lakhs. 8 lakhs. Put to use for less than 180 days. For convenience, I am doing like this. New asset. So that you can, in exam also you can do like this. The format, presentation of the answer, if it is clear, you will get a better appreciation only. 3,25,000. Okay. Whereas second hand asset. Second hand asset is 2 lakhs. 2 lakhs. Here it is purchased and put to use for more than 180 days, 250. Sale value deletions, nothing but the sale value is 3,10,000. Balance available for depreciation less depreciation under the normal. Please understand. Please understand. 3,25,000 plus 2 lakh into 7.5% into 7.5%. 5,25,000 into 7.5% plus 15,93,000 minus 325 minus 2 lakhs, okay, into 15%. Repeating these two, 5,25,000 into 7.5%. From 1593 reduce 525 and claim on the balance. Here simple 40%. Here simple 40%. Additional, all of us remember this into 20% plus this into 10%, not for the second hand asset. Not for the second hand asset. Closing WDV. For pollution control equipment, you can have two assumptions. Used in the manufacturing or main activity, you can claim additional depreciation or not. That I leave it to you. Okay, that's an assumption only, don't worry. Total depreciation. Don't worry about pollution control, additional depreciation. You can have the assumption, or you can say that it is assumed. I have assumed it the other way. Okay, 492. Now understand. It is in the last two questions I did not write. Here I am writing so that we're communicating to the examiner. On the asset purchased and used for less than 180 days, balance additional depreciation of 10% can be claimed in financial year 21-22. If you write it and close, then the answer will stand tall. Then the answer will be better. Okay, okay. So this is how depreciation needs to be computed. This is how depreciation needs to be computed. Let's take the 15-minute break now. Let's take that 15-minute break now. So the one of the important part of our depreciation explanation is this point called additions. Is this point called additions. What constitutes addition is important to understand. Repeating, what constitutes addition? What are all included in addition is important to understand. What is meant by that term addition? We need to understand this to move forward. Okay? As like our accountancy, as like anything, any direct expenses incurred will be treated as addition. Any direct expenses incurred will be treated as addition. Installation charges, carriage inwards, expenses, trial run, borrowing cost till the asset is put to use. Any expenditure of capital nature will be addition. And the most important explanation comes here, that is section 43, which speaks about 43A, in fact, which speaks about Forex accounting in the case of assets. Okay, section 43A, Forex fluctuation for asset acquired. Okay, this is something which you need to understand. Forex fluctuation for asset acquired. Let us take date of import. It was $10,000 and the dollar rate was 70. So I would have accounted it as 10,000 into 70, 7 lakhs as the value of the asset. 31st March, the dollar rate is rupees 72. No adjustment in income tax law. No adjustment in income tax law. In other words, income tax law does not have the concept of restatement of values for assets. Repeat along with me. Income tax law does not have the concept of restatement of asset value. There is nothing called restatement. So you need not 20,000 rupees will not be accounted on 31st March. Date of payment, it was 74. So 10,000 into 74. This difference, 7 lakh 40 minus 7 lakhs, will be accounted as increase in the value of asset. It will be increased in the block. It will be increased in the block. I think accounting standard says this should be taken as expenditure, but income tax law says it should go to increase the block value. So, to write it theoretically, to understand it theoretically as a concept, on the date of transaction, rate prevailing on that date will be capitalized. On the date of transaction, rate prevailing on that date, asset will be capitalized. Adjustment will only be made when the payment is made. Adjustment will only be made when the payment is made. There is no concept of restatement. On the date of payment, the difference between value paid and value recorded will be adjusted with the cost of the asset. If it is more, increase. If it is less, decrease. According to section 43, Forex should be recorded only in the year in which payment for the asset is made. Normally in accounting, we might record for exchange rate fluctuation every year end, but under tax law, the difference will be recorded only in the year in which payment is made. The difference can be add or less. Anything. Less GST credit, subsidy if any received, and sale consideration. Subsidy if it is in the asset. Depreciable asset. Having said this, on a single day, once more, on a single day, if payment is made in excess of 10,000 through unapproved modes, then it will not form part of asset value. I purchased an asset for 80,000 paying cash. I can never record it as addition. I can never record it as addition. On a single day, in excess of 10,000 by unapproved modes. Unapproved modes are cash, bearer check, crossed check. Then such sum will not be part of the asset value at all. It will not be recorded as addition. It will not be recorded as addition. Okay, so addition, all expenses will be forming part of addition. Forex fluctuation between the date of purchase and date of settlement. Date of purchase and date of payment will be also adjusted. Increase means increase, decrease means reduce. Subsidy for depreciable asset should be adjusted with the cost of the asset. Fine. Some special circumstances. How to record the addition? One base law I will give you. Any succession cost prevailing in the previous owner's books. What is succession? Succession means conversion of firm into company, sole proprietor into company, company into LLP. Amalgamation, demerger, holding subsidiary. In all these things, the cost of the asset to the transferee will be the cost prevailing in the books of transferor. Provision will apply to the transferee company as it would have applied to the transferor company, as if such event did not happen at all. In all those cases, cost of the previous owner. If an asset which is used for scientific research is transferred to the block, 0 is the value, because already you have claimed the full value, now nil. If my own asset or an asset which I inherited or received it as gift is brought into the business, once more, if my own asset building brought into the books after its usage, or a gift or other asset brought into the business, date of original purchase minus depreciation till 1/4/2020. We should compute and bring the asset value. Had I originally purchased it for business, what would have been the depreciation? That can only be claimed. That can only be claimed. Okay? Okay? And in this, the most important is these two. Asset which I earlier transferred, now I am acquiring. Asset sold and purchased back. Because my book value is less, what I am trying to plan is, I sell the asset to you and buy back the asset at a higher price. I sell the asset to you and buy back the asset at higher price. Not acceptable. Asset earlier transferred, reacquired. Book value at the time of transfer or actual cost of reacquisition. Book value at the time of transfer or the price at which you reacquired, whichever is Less can only be recorded. Don't use it as a tax planning mechanism. If I purchase a second-hand asset, in the market it is available for 1 lakh, but from a friend I am purchasing for 10 lakhs. In the market it is available. Purchase of second-hand asset, actual purchase price or FMV on the date of purchase, whichever is less. Please go through this table once. I will make you understand this practically also. Rarest question, but I just want to once brush through and go. Compute depreciation in each of the following cases. Ramesh, after purchase and put to use on 15/12/2018 a machine worth 3 lakhs, which is eligible for 15% depreciation, sold this machine to Ganesh on 1/1/20 for 3,20,000. FMV on the date 250. Who, after using the machine for his business purposes, sold it back to Ganesh on 15/11/20 for 310. Compute the amount of depreciation and gain, if any, for assessment year 2021 and 21/22, assuming this was the only machine in the block for both Ramesh and Ganesh. Read through. Addition on 15th December 2018, 3 lakhs, less depreciation for 18/19 at 7.5% as the asset is put to use for less than 180 days, because it is purchased on 15th December 2018 into 7.5%. Opening WDV as on 1/4/19 is 277,500 is 277,500 1/4/2019 277,500 opening WDV. He sold the machine to Ganesh on 1/1/20 for 3,20,000. Less sale value of machine 3,20,000. If a depreciable asset is sold and the block is no more there, result is short-term capital gain. If a depreciable asset is sold and the block is still not there, we will see it in capital gains. Also short-term capital gain for FY 1920. For Ramesh, it is a short-term capital gain for FY 1920 because the value of the machine is 277,500. This is the only machine in the block and the block is sold. There are other machines, I will adjust it, but here the block is sold. So the short-term capital gain is 42,500. And the opening WDV as on 1/4/2020 will be nil. The opening WDV as on one, because the block is gone, the opening WDV. Addition of the same machine. Later in the year, having used the work, who after using the machine for business on 15/11/2020 sold it back to Ramesh for 310. So Ramesh is again purchasing addition of the same machine on 15th November. On 15th November. Okay. Actual cost of addition 3,10,000. Value prevailing in book on the date of transfer 277,500. 277,500 on the date of, that's why he got 42,500. This 277,500 is only the value. According to section 43, that an asset transferred earlier is bought back. An asset which I had, which I sold and again purchasing back, bought back. Value to be recorded in addition is actual purchase value, or value to be recorded in addition is actual purchase value or value prevailing at the time of transfer, whichever is less. Whichever is less. This is the law. So I can only record 277,500. I can record only 277,500 because at the time of transfer, sale, my book value was only 277,500. Less depreciation for 2021. Depreciation for 2021. Again, I can claim only 7.5%. Okay. At 7.5% as the asset is purchased and put to use for less than 180 days. Closing WDV . Actually, this is the answer. In the hands of Ramesh, the problem is he is paying capital gains tax in 1 year, and even though he paid 3,10,000 for the asset value, because he is purchasing his own asset again, he cannot record any other value other than whatever is prevailing in the books, or if the new value is lesser, he cannot forget. Rare, but I want you to understand this provision. If at all there is a question, even as an adjustment in one of the questions, you should be able to answer. In the hands of Ganesh. Ganesh purchases in financial year 1920 a second-hand asset from Ramesh. As far as Ganesh is concerned, he is not buying a new asset, he is only buying a second-hand asset. According to section 43, in case of second-hand asset, purchase value will be actual value or FMV on the date of purchase, whichever is less. Whenever we are buying a second-hand asset, okay, purchase of second-hand asset, actual purchase price or FMV on the date of purchase, whichever is less can only be taken. Whichever is less can only be taken. Okay? Whichever is less can only be taken. In this case, you can see he sold the machine to Ganesh on 1/1/20 for 3,20,000, whereas the fair market value on the date is only 2,50,000. Is only 2,50,000. So, actual purchase value 3,20,000. FMV as on 1/1/20, that is the date 1/1/20 is 2,50,000. Whichever is less can only be taken. That is the problem for Ganesh. Less depreciation at the rate of 7.5% as it is put to use for less than 180 days, because you have purchased on 1/1/20 only. So this into 7.5%, I am getting an opening WDV. I am getting Ganesh, for Ganesh I am getting an opening WDV as on 1/4/20 as 2,31,250. For Ganesh, I am getting an opening WDV as on 1/4/20 as 2,31,250. Less sale value of asset. Less sale value of asset. On 15/11/20, he sold it for 3,10,000. He sold it for 3,10,000. Now he is having a short-term capital gain for financial year 2021. Okay, 310 minus 231,250. So this is the biggest problem if you do a transaction like this. everywhere, every person will end up paying more taxes. Take down. A rare question, but still, I want to put it somewhere into your mind. Rare question. Sudarshan purchases a building for rupees 20 lakhs on April 22, 2016. He has let it out for some business purposes. The tenant vacates and the said date. He converts his building into business premises for the purpose of carrying on his own business. What should be the value recorded? The law says depreciation that would have been charged on the actual cost of the building, when it's all allowable, had the building been used from the date of its acquisition. From the date of its acquisition, had I used it for the purpose of business, what would have been its value? Purchase price of building on April 2016, 20 lakhs. Purchase price of the building on April 2016, 20 lakhs. In July 20, he is bringing it. So I want till 1st April 20. Always in income tax law, in between date depreciation is not there. Only 31st March. So less all buildings will have 10%. Or actually opening WDV as on 1/4/2017. '18, '19, '20. Opening WDV as on 1/4/2018. Opening WDV as on 1/4/2019. Opening WDV as on 1/4/2020. So this will be the value of addition in the books for the building. So for the current year, on this I can claim depreciation. For the current year, on this I can claim the depreciation. Depreciation for 2021 will be this, closing WB. Okay, okay. A foreign company purchases a computer for $12,000, biogas plant for $20,000. These were put to use outside India. On first March, the company starts a manufacturing unit and transfers to Indian factory. The same manner you should work it. I'm not reworking. You can check the answer later. In the same manner you should work out. For each asset, you should find out the 1420 value. For each asset, you should find out the 1420 value. Answer will be there with you. Let's not waste time. Okay, so you know how to work it out. So bring it to that level. That is how this special additions, very rare question. Especially you remember that second hand asset and repurchase of same asset, that is sufficient. So sale consideration of the asset will also include insurance compensation, because in our capital gains we will see this insurance compensation is also part of it. Am I clear to you? So normal depreciation, additional depreciation, now comes an interesting and unique concept called unabsorbed depreciation. Unabsorbed depreciation. Okay, so if the depreciation is more than the profit before charging depreciation, if the loss is due to depreciation, then it is known as unabsorbed depreciation, which needs to be carried forward for indefinite time period and can be set off against any income. If profits available after deducting all expenses are not sufficient to cover the whole depreciation, uncovered portion is known as unabsorbed depreciation. The rest of it in set off chapter. It's a big benefit available, big benefit. Proportionate depreciation. Sir, just now you were saying that there is no concept of proportionate depreciation under the income tax law. But now we are talking, or we are writing a heading called proportionate depreciation. Let me be very clear. There is no concept of proportionate depreciation under income tax law. There is no concept. Then this is not proportionate computation. Computation is more than 180, less than 180. It is proportionate distribution of the computed depreciation. I am still holding good There is no concept called proportionate depreciation under the Income Tax Act. Write it and keep it. 9 by 12, 7 by 12, 6.5 by 12, 3 by 12, 180 days or more, less than 180 days. In a case where depreciation has to be claimed for the same asset by more than one assessee, depreciation has to be claimed for the same asset by two people. Compute the depreciation and distribute the depreciation in a proportional manner. It is only proportionate distribution and not proportionate computation. It is only proportionate distribution and not computation. Amalgamation, demerger, conversions. In all the above cases, depreciation will be computed ignoring the event. The event did not happen. Normally, how you will compute? Complete. And such computed depreciation will be distributed based upon very highlighting word, effective usage period of asset. Effective usage period of asset. Very important to understand. Read it. Read it once. The most important word to understand it, it will be divided on the effective usage period. $193 it should be. Smriti Limited has a block of asset of 15% rate whose WDV is 40 lakhs. It has purchased another machine, second-hand machinery of the same block in November for 14.4 and put to use on the same date. Smriti Limited amalgamated with Shruti Limited on 1st January 21. Compute the depreciation that Smriti Limited and Shruti Limited can claim, assuming the asset was transferred by Smriti Limited to Shruti Limited at 60 lakhs. Read it. First, let me break the last line. according to section 43, in case of succession means amalgamation, demerger, all types of conversion. The value to be recorded for asset in the books of transferee is the value prevailing in the books of transferor. The value to be recorded in the books of transferee is nothing but the value prevailing in the books of transferor. The value to be recorded in the books of transferee is nothing but the value prevailing in the books of transferor. So you cannot record it as 60 lakhs and all. That is ruled out. Ruled out. Okay. Computation of depreciation. Follow my answer. Opening WDV 40 lakhs. Additions put to use for less than 180 days because it is purchased on 1st November for 14,40,000. Here I want you to understand, so please take your time. On the opening balance, on the asset purchased at 7.5%. Why I have done like this, I will tell you, please. Okay. Distribution of depreciation on effective usage period. Okay, distribution of depreciation on what basis? Effective usage period. Effective usage period, very important. Particulars, Shruti, Smriti. Opening balance. Shruti Limited used for 31 days of January, 28 days of Feb and 31 days of March. Shruti Limited used for 31 days of January, 28 days effective usage period. Shruti Limited has only used for 90 days. Smriti Limited 365 minus 90. asset purchased on 1st November 2020. Shruti Limited would have used for the same 90 days, Jan, Feb, March. Whereas Smriti Limited 30 plus 31, 61 days only. The effective usage period of the asset is only 151 days, 90 days of Shruti, 61 days of Smriti. So, opening balance depreciation, that is 6 lakhs divided by 365 into 90. Whereas Smriti can claim the balance. I hope you are following. Very big nuances involved here. The usage period wise, I did not compute it like that. At the time of computation, I did the normal thing. But when it comes to distribution, distributed on the basis of effective usage period. That is where I need to find out how many days they are using. On additions, 1,08,000. Total usage period itself is 151. Of that, 90 belong to Shruti. The balance belongs to Smriti. Very nice concept. Application should be stronger. Then we are through with it. Pushpak and Co. The partnership firm was converted into a private limited company with effect from 1st November 20. However, the company commenced its business and started using the asset only from, and the company started using the asset only from 1st March 21. Very, very, very interesting question. Very, very, very interesting question in one manner. The total usage period for opening balance, I'm saying you, transfer or entity is April plus May plus June plus July plus August plus September plus October. Repeating, April, because first November varaikkum, okay? April, May, June, July, August, September, October. Transferee entity only March. So, effective usage period for the opening balance asset itself will be only 245 days. For computation, go by our normal method. For distribution, the law says effective usage period, which has a nice thing to understand. Opening WDV of computers and plant and machinery on 1st June. Another plant and machinery was purchased. So for that, what you should do? June, July, August, September, October, plus 31 days of March. Okay. With your permission, I will just look into the answers so that let's not waste time. Okay. Now that you understand what is effective usage period, it helps me in making you understand with ease. So I computed depreciation in the normal manner. I computed depreciation in the normal working methodology. While computing distribution, you can see total number of days. Remember, effective days should only be taken and not the whole year. The company started using it only from 1st March. So 214 days for firm, I told you how, 31 days for company. For asset purchased, June, July, August, September, October, 153, 184. That is how we have distributed. So, this is depreciation for your understanding. This is depreciation, and this is the mode by which depreciation will be computed. With its small intricacies, standalone question in depreciation is not going to be possible because but if at all there is an adjustment, you know how to immediately remember this. That's why we recollected so much.